You know, you know, you know what it do best. This is your boy EK Givino from EDU-GURUS. Your one and only mentor, guys. When you got me, you don't have the best, but then, guys, you got it all. So, guys, today I will be focusing on Eastern Cape question papers, which was actually an exemplar for November 2020 in preparation for your exam, guys. So, a warning, guys. This is not how your exam is going to be, right? This is only preparation of your exam. It's not like your exam will look exactly like this question paper. But guys, when it comes to accounting, the principle is the same. The very same principle that you apply in this question paper is the very same principles that you're going to apply in your examination, right, guys? So I'm not going to do the whole question paper today, guys. Today, I'm not going to do the whole question paper. I'm not going to do the whole question paper. As you guys know, most of the time, when I issued a video based on my own question paper. But unfortunately, this time I was not able to set my own question paper, right, guys? So next time we'll be setting our own question paper and present our own question papers. But I think this one is gonna be helpful. So guys, I'm not going to present the whole question paper. I'm just going to focus on financial indicators. I'm just going to focus on financial indicators. Guys, know how to interpret your question paper. Know how to interpret your question paper. Like, guys, when it comes to grade 11, I believe 96% is possible. I believe 96% it's possible here, guys. Guys, check the marks of this question paper. We have fixed assets. Guys, if you know the basic of fixed assets, there's a high possibility that you may collect the marks as it is. When it comes to fixed assets, guys, when it comes to fixed assets, there are a lot of operational marks, especially when you're required to prepare your fixed assets note. Um, Especially when you're required to prepare your fixed assets note, there are a lot of operational marks, guys. Please collect these marks. Know how to calculate depreciation, carrying value, and everything, guys. Then we have question 2, which is gap and income statement, guys. These are very free marks. Know your format when it comes to income statements. Know what falls under your other incomes. Know what falls under your operating expenses. If you fail to do so, guys, you're going to penalize you. -1 from your original marks. So, guys, please make sure that when you go to examination, you know your income statement format together with your balance sheet and note. Know your format, guys. So format is very important. If you fail to master your format, you guys are going to lose a lot of marks. 45, 45, income statements and balance sheet. Balance sheet, there's a high possibility that you may get distinction over that 45 with the wrong amount just by mastering your format and put the incorrect amount there. Like balance sheet is full of operational marks, guys. So please make sure that you collect that 45 marks or at least 70% or 80% of 45 marks, guys. Then financial indicators and interpretation of financial information. So this is our major focus for today: financial indicators and interpretation of financial information. So guys, this is one of the very important question, and most of the students, they fail to collect these marks because of they think accounting is basically most of the time about calculations. No, guys. If you really want quality marks when it comes to accounting, make sure that you master theory part of it. Financial indicators, guys, is the same. You go to grade 10, 11, and 12. Like the comments are the same. What you just have to do, guys, is to master your formulas of financial indicators. Know your formulas. You guys will be provided with formula sheet. So if you don't know what is acid test ratio, if you didn't practice acid test ratio or current assets ratio, there's no way you can be able to identify the ratio in your formula sheet. So make sure that when you go to examination, you know your format. You also know the formulas of financial indicators. Like, guys, only with paper 1, guys, you guys can pass accounting without writing paper 2. Just by mastering your paper 1. Paper 1, it's not that much easy when it comes to accounting, but then at least, guys, you can make it. You can collect. I think 86% is possible on paper 1, guys. So make sure that when you know your financial indicators, formulas, and you also know your format. Fixed assets, I know most of you guys are facing some difficulties, but if you guys still face some difficulties with regard to fixed assets, please text me on 083 427 3112 so that I can give you guys some few notes with regard to fixed assets, guys. And also I've issued a video with regard to fixed assets, so just go through to that video. I promise you guys, if you can go through to that video, I know it's a long one, but it's going to be beneficial. It's going to be beneficial, guys. So guys, before I go through to this question 4, I just want to make some few announcements. So guys, basically next year we're not going to provide public service. You know, guys, we have been providing free public service for the whole 2022. Whereby we have been tutoring face to face. We have been tutoring most of the time. Our focus it was on our second year student. So guys, next year we are going to cancel public service. So what we're just going to do next year, 2023, we're just going to provide private sessions whereby you will pay for our service, right, guys? Then by December, guys, we are going to have a program. It's a national goodbye program whereby we are going to invite all a class of 2023, meaning people who are going to do matric for 2023, specifically for accounting student. So guys, here I will be tutoring you guys for a period of 2 months, meaning December and January. I will be providing you guys with a free service via WhatsApp and also via Zoom. If I have to record the videos, I will record the video and send the contact to you guys. So guys, in this national goodbye service, this is the program that I've started, whereby I'm going to offer 2023 class of 2023 grade 12s a free service. I will be introducing a new topic which is new to you guys, companies. I will be introducing companies and all other challenging topics so that you guys can be prepared for 2023. The reason why I started this program, it is because of, like I said, I'm not going to offer any public service next year. So I'm going to take a break, focus on my studies because of most of my tutors next year it's their final year, so we have to minimize a little bit of our sessions and try to focus on our studies and improve where we have to improve. Nice, right? So I will be back by 2024. That's whereby I can now provide free public service from grade 10 to a third year student So this national service, like I said, it's only for class of 2023 students who are doing accounting or learners who are doing accounting, right, guys? So this is for the whole South Africa. Each and every student who's going to do matric next year by 2023 across South Africa, you guys are more than welcome to join the program. So as soon as you guys get your report, then that's whereby I will start to create a group. That's where the group will start to operate. So this is going to be a very strict group. This is going to be a very strict group. If you fail to respect us, and also if you fail to fulfill your obligations, meaning you fail to do your homeworks, you fail to submit your test, we're going to have a lot of work to do. So we are not going to enjoy our December, but I'm going to give you guys a break during December. During December, not just like going to focus a lot um on those classes, right? So I will be giving you guys a break, but like then we are going to work each and every day. Each and every day there's going to be an activity. Each and every weekend there's going to be a test. If you fail to submit our activities, I'm going to take you out of the group. If you fail to write your test and submit your test, I'm going to take you out of the group. If you fail to participate in the group, I'm going to take you out of the group. So I hope I've made myself clear. I hope I've made myself clear. So now let's go through to question 4, financial indicators. So guys, this is one of the important session. This is one of the important session. This is one of the important sessions. So let's go to question 4. It says financial indicators and interpretation of financial information. This question is worth 30 marks and you're required to write it within 25 minutes. So let's go straight to 4.1. It says calculate the following financial indicators as at 30 June 2020, which is exactly the end of this particular business financial year end. So guys, 4.1.1, we are required to calculate the acid test ratio. So guys, it's very important to know the formula. It's very important to know the purpose of the ratio that you are dealing with, or the purpose of indicator that you're dealing with. And also it's very important to apply that financial indicators in a form of theory, guys. So now let's talk about acid test ratio. Before I go to acid test ratio, this session is specifically for grade 10 and 11 and some of grade 12s. Grade 12s, this is actually a limited one. So for my fellow grade 12s, I'm sorry, this is not for you, but there are some of the ratios that are there in grade 11, grade 10, and they are still there at grade 12. So guys, there are some of the ratios that are not there in grade 12, but they're there in grade 11. The reason being, when it comes to grade 11, we are dealing with a partnership. So the ratio, they will differ according to the type of company, according to the type of ownership that you're focusing on. Remember, when it comes to grade 11, we're focusing on partnership. Then when it comes to grade 10, we're dealing with sole proprietorship. Then when it comes to grade 12, you are dealing with companies. So the ratio, they will differ. Acid test ratio, debt equity ratio, I think it's there for grade 10, 11, and 12. But retained earnings, they differ. They differ according to or the type of ownership you're dealing with. Right, guys? So let's get to the business of the day, guys. So most of the time when it comes to grade 10 and grade 11, they will ask you guys more about profitability ratio. So guys, make sure that you know all your profitability ratio, right? So now, like I said, in 4.1, you're required to calculate the acid test ratio. First of all, when you see this type of question, make sure that you know your formula, make sure you know the purpose of the ratio, and also you should be able to apply it in the scenario or in whatever form of question of theory you're given. So now we are going to acid test ratio. First of all, we start with the formula. The formula is current assets subtract by your inventory is to current liability. You divide it by current liability. So what does that mean, or what is the purpose of acid test ratio? Let's start first by identifying the meaning of current assets. What falls under the current assets, remember, it's inventory, trade and other receivables, cash and cash equivalent. Please listen very attentively, guys. What falls under the current assets is it's inventory, trade and other receivables, cash and cash equivalent. What falls under the current liabilities is trade and other receivables, bank overdraft, current portion of O, and others. So in this acid test ratio, we are saying over all of these current assets, we are going to subtract the inventory. So meaning if we take the current assets, then we subtract the inventory. Now we are left with trade and other receivables and cash equivalent. So now let's explain the whole meaning of current assets and the whole meaning of current liabilities. So when we are talking about the current assets, we are talking about the assets that we need or that we incurred during the operation of the business, specifically for a period of 12 months. I hope it does make sense. Current assets, you're talking about the assets that we incurred during the current financial year, specifically for that current financial year, meaning we need them for the operation of the business for the period of 12 months. Let's elaborate more on trade and other receivables. Remember, when it comes to trade and other receivables, we are talking about our creditors, the creditors that we sold on credit to. We may have some bad debt prepaid expense. We may have some prepaid expense and accrued income. Those are the current assets that we incurred during the year, right, guys? And cash equivalent, you may have petty cash, cash flow, then bank. Those are only within the period of 12 months, Guys, so when it comes to acid test ratio, it says over these current assets, subtract your inventory, then you'll be left with trade and other receivables and cash equivalent. So it says, based on your trade and other receivables, cash and cash equivalent, are you able to settle your current liabilities? Only depending on your trade and other receivables and your cash and cash equivalent, are you able to settle your current liabilities that you incurred within the current financial year without depending on your inventory? That's the purpose of acid test ratio. Are you able to settle your current liabilities using your current assets without depending on your inventory? That's the purpose of acid test ratio. So the acid test ratio, it have to be more than 1 if it's positive. So meaning it can be 1,5:1. 1,5:1. It have to be more than 1. If your acid test ratio is 1 and 1, meaning meaning your current assets excluding the inventory, it's equals to your current liabilities. So this can put a company in a financial risk. This can put a company in a financial risk. What's the use of you incurring your current assets, which is the same as your current liabilities? There should be a difference in between. You should benefit from your current assets. So meaning if your ratio is 1:1, so meaning the very same amount that you collect from your debtors, the very same amount that you collect from the debtors, or the very same amount that you sold on credit to your debtors, is the same as the very same amount that you incurred on your liabilities, on your the very same amount that you pay to your creditors, the very same amount that you pay to your salaries and wages. Do you guys get to the point of that? So there's no purpose of saying we have a business. Remember, the purpose of the business is to make profit. But if your ratio is a test ratio, it's 1:1, then my current assets is the same as my current liabilities. So there's no profit there. Hence, I'm saying you guys should focus on profitability ratio. So acid test ratio, it's one of the profitability ratio. If my ratio is 1:1, there's no profit there. But if my ratio is 1,5 or more is to 1, then that's why we can say now this business is making or generating a profit. But if ratio is 1:1, then there's no profit that we incur there. I hope the acid test ratio is very clear. And let's move to we are going to do the conjugation. Now we're just like discussing. Now we are just discussing the ratios that we're given here. So now we are moving all along to debt equity ratio. I think this is one of the solvency ratio, right, guys? So when it comes to debt equity ratio, here's the formula of a debt equity ratio. You should be able, they will give you a formula sheet. So the acid test ratio, its formula is non-current liabilities divided by owner's equity. It's non-current liabilities divided by owner's equity. So what do we mean when we're talking about owner's equity? Owner's equity is combination of your current account and your capital contribution. The non-current liabilities, we're focusing on the long-term loans in most of the cases. So a debt equity ratio, it says, are you able to settle the borrowed fund with your equity? Like here we want to compare the difference between what is invested and the borrowed fund. I hope it does make sense. When it comes to debt equity ratio, we want to check whether the money that is invested in the equity, like we want to check or compare the difference between the borrowed fund and also the money that is invested into the business. So a positive gearing or a low risk gearing, that's whereby at least the ratio is 0,5:1. That's the positive gearing. So that simply means if your ratio is 0,5:1, that's whereby we can say your borrowed fund, it only costs 50% of what is invested into the business, right? So if my borrowed fund is equal to 50% of what is invested into the business, then I'm not in any financial risk. So I'm still in a positive gearing, or I'm still in low risk. I hope it does make sense. So most of the time, this debt equity ratio, it can appear in the form of theory, and its theory, it will be based on loan in most of the cases. It will be based on loan in most of the cases. Like you'll be given a scenario whereby they say, the entity made an additional loan on top of the loan that they have. So comment on the debt equity ratio, comment on the financial risk of the business. If your debt equity ratio is below 1, meaning it's 0.5 is to 1 or 0.6 is to 1, we are still in low gearing. We are still in a low risk, whereby the company is not, or the entity is not in financial risk. So meaning even though they can take some additional loan, but as long as their ratio is 0.5 or it's below 1, then the company is not in financial risk. I hope it does make sense. Or sometimes I can ask you guys, the entity or any of the partner, they want to take additional loan. Advise this entity whether it's a good idea for them to take a loan or not, or they already took the loan. So you want to check whether it is a good idea that they've taken for them to take additional loan or not. As long as you calculate the debt equity ratio and it's below 0.5, then it's good for this entity. Like it doesn't place, or them taking additional loan, it doesn't place the entity in a financial risk. Why? Because of their borrowed fund, it's still less than what is invested into the business. So they can take as many as additional loans as they want if they face some financial difficulties into the business, or if they have some cash flow problems, or they want to improve a certain portion of their building, or whatever they want to improve to the business. They need money, they need immediate cash flow into the business. As long as their ratio is below 1, meaning it's 0.5, 0.6, and so on and so forth, then this company, it can't take additional loan. Why? Because of they are still in low gearing, or they are still in low financial risk. As long as their ratio is below 1, then they can take as much as they want, additional loan as much as they want. Why? Because of their borrowed fund, they are not higher than what is invested into the business. That's how debt equity ratio it can appear in today's case. But then we are just going to go to that, guys. So chill out. We're just going to go to that. But then, yeah, now we are discussing. So the purpose of debt equity ratio. That's whereby we check the financial risk of the company. Where is the company standing? Just imagine, maybe my borrowed fund, let's say maybe my debt equity ratio is 1 and 1, 1 is to 1. So that simply means my borrowed fund is the same as what is invested into the business. So this entity, they won't be able, just imagine, like my borrowed fund is equals to, is the same as what is invested into the business. So what's the use of us being investing into this business, whereas we are not going to get a better returns, or we're not going to get anything at all? So meaning this company, it put the company in financial risk, whereby there's high possibility that this entity in the future, or in the very same current financial year, they won't be able to settle their debt. They can, like this, it can put this can put a company in a financial risk, whereby sometimes can force the company to be liquidated. Or if the ratio is higher than 1, let's say maybe it's 2 is to 1, then a company is high in a financial risk, like it's a high gearing, meaning this company is on a high financial risk, meaning their borrowed fund is more than what it's invested into the business. So that's a high financial risk. So the shareholders or the investors, they may not get some better returns if the company is in high financial risk. Obvious, when it comes to the business, what is important is the creditors and also the investors. That's the most important things when it comes to the business. But before we can settle our investors, we have to make sure that we settle our debt first. So if the company is in high financial risk, or the debt equity is high, that simply means we have to settle our creditors first before these investors, they can get something. So there's high possibility that if the company is in a high financial risk, there's a high possibility that we may generate money, we may sell our assets if maybe we face some liquidity problems, or if we are in a liquidity whereby we are enforced to liquidate our assets. Therefore, we will start first by settling our creditors before we go to our investors. There's a possibility that our investors, they won't get any returns based on what they have invested. Why? Because of this company, it was not managed efficiently. It was in a high financial risk whereby their debt, they were higher than their assets, and also their equities or what is invested into the business. Can you guys see how do we interpret financial indicators? In financial indicators, you just like use your business common sense. Jay. But if you know the meaning of asset test ratio, if you know your purpose of debt equity ratio, that's whereby you can comment in a good way, right, guys? But make sure that your comments, they make a commercial sense. It have to be related to the business and also to accounting, guys. So here, please, guys, don't miss any of this question, guys. 30 marks, it's highly possible. At least if you're not going to get 30 marks, at least try to collect 20 or 25, guys. So now let's go to the question by its own. So what I'm going to do here, I'm just going to perform the calculations on this side, on the world here. With this. Okay, we are going to perform the calculation here on the world. What's happening with my world now? Okay, my world is acting up. Okay. Let's try to enlarge this. So yeah, guys, we're going to start with a 4.1. We're going to answer a 4.1. So 4.1, let me just try to minimize this one and extend this one. Yeah, might it's quite a bit clear. So guys, we're going to answer 4.1. 4.1.1. Right, guys, we are required to calculate the asset test ratio. Test ratio. And the formula is current my word is acting up. Current asset subtract your inventory. Inventory is to your current liability. Right, guys, so let's go to our information and check what is our current assets for the current financial of 2020. Right, guys, so here it's our total of current assets is 294,650. Then let's just like post it here. So we have to subtract it by our inventory, which is 93,750. Right, guys. Then is 2, the current liability. What's our current liability? Here we go. Here it's our current liability, 190,500. Let me just try to maximize this amount. I think it's quite a bit clear. So now let's get this total here. Let's get this total. If we if you take 294,650, 294,650, I should have performed the calculation on Excel. It's 200, 900, and then 190,500. Then for us to get our ratio here, we'll have to take our 200,900, then we divide it with 190,500 so that we can get the ratio, right, guys? So I come across my ratio as a 1,05. Here we go. This is my ratio for acid test ratio. Then here on this side, it's always 1, 0.05 is to 1. Then here it's my ratio for acid test ratio, guys. I hope it does make sense, right? Let me just try to move to Excel so that we can move a little bit fast, right, guys? So just let's just like take a quick break, then we'll be back. Welcome back, guys. So I just moved to Excel so that I can perform the calculation very quickly. Very quick. Okay, guys. So now let's move all along to 4.1.2, right? So 4.1.2, we are required to calculate debt equity ratio, right? Debt equity ratio. Let me just try to enlarge this one so that you guys can see, right? Okay, guys. So debt equity ratio, guys, remember it's current liability. Non-current liability is to owner's equity. Owner's equity, yes, right? So this is our formula for debt equity ratio. So let's go to our information and find out where it's our non-current liability. So our non-current liability is 450. Right, guys? So it's gonna be 450. It's gonna be 150. Let me just type it out. So it's gonna be 450,000 is to our owner's equity, guys. So here it's our owner's equity. It's 1,425,800. So now I want the ratio. If I calculate my ratio, I have to take 450,000, then I divide it by 1,425,800. So here we go. My ratio, it will be 1 on this side. And then on this side, it have to be 450,000. I have to divide it with 1,410,000. Okay. Let me just perform the calculation. It's equals to 450,000. Then I have to divide it with 1,425,800. Okay, let me just perform the calculation correctly. So it's equals to 450,000. I have to divide it by 1,425,800. Okay guys, welcome back. So guys, I've just moved to Excel from my calculation here. So we are done with 1.1.1. So now we are moving all along to actually 4.1.1, and now we are moving all along to 4.1.2. So we are required to calculate debt equity ratio. So a debt equity ratio, its non-current liability is to owner's equity. So if you go to our information here, we find out that our current non-current liabilities is 450,000, right? So it's gonna be 450,000 is to our owner's equity. It's 1,425,800. That's my non-current liabilities and my owner's equity. So for me to get my my ratio here, I have to take this non-current liability, then I divide it with owner's equity, which will give me the ratio of 0.31 is to 1. As always, when it comes to your right hand side, is equals to 1. Right, guys, your right hand side as always is equals to 1. You have to let it to be 1 as always. Then your left hand side, it have to be performed by the calculation whereby you will take your non-current non-current liability, you divide it with your owner's equity. That's how we go about it. So according to 4.1.3, 4.1.3, we are required to calculate the retained earnings. I can say it's a retained earnings or the retained end. So the formula of the retained end is total the total amount and then divided by average equity. Here we go. Let me just show you the formula in the formula sheet. It's a total earnings then divided by owner's average equity. So it's a long one. I'm just going to minimize it by saying total, and then I have to divide it by average equity. It's average equity, guys. Side. So I'm going to calculate my total earnings. So guys, when it comes to the retained earnings, the purpose of this ratio is to calculate how much are you going to earn based on what you have invested into the business. That's the purpose of this ratio. How much you as the investor are you going to earn based on what you have invested into the business. Right, guys? So my total earnings, it will be based on all the movements of that particular partner for the current financial year. We are going to take your interest on capital. We are going to take your salaries. We are also going to take your balance of current account together with your salaries and everything. If you have bonus, you're also going to take bonus. All your earnings for that particular current financial year, we have to add them. That's your total earnings. So now, according to this question, they say we have to calculate the retained end by Kagisho. So we have to take the interest on capital of Kagisho, the salary and the bonus if he does have the bonus, but unfortunately here it's only Radaba who only have the bonus. And also the current account of Kagiso. So here we go. When we perform our calculation, we'll open the brackets here. We will add the interest on capital, which is amounted to 47,250. Then we are going to add it with the salary of 168,750. Then we add it with it doesn't have the bonus, so you'll add it with your current account of 16,200. 16,200, guys, right? Then we will divide this with the average equity. So guys, listen very attentively. If it says the average equity, you're gonna go to your trial balance or whatever that is given them. You're gonna add all the equity from last year and this year. Then after adding the equity from last year and this year, then you will have to divide it by 2 or multiply it by 1/2 to get your average equity. That's how we go with the average equity, guys. The average equity, you add the equity for last year and this year, you add them together, then you divide it by 2, or the total amount, you multiply it by 1/2. Then you will get your average equity. So here, the average equity, guys, I want to do it separate here so that you guys can see it here. Then I'll post it to the formula as soon as I get the total, guys, right? So the average equity, we will take, remember here we are focusing on Kagiso. So we'll only take the equity of Kagiso. So we cannot take the whole amount of 1,385,900 and also one because of it's one of 1,425,800 because of it's a combination of two partners. So for 2019, we will calculate the equity of Kagiso here, right, guys? Let me just try to enlarge my screen here. Okay, I hope you guys now can see me. Okay, so we are going to calculate the equity for Kagiso for 2019. We'll start with his capital contribution at 650,000, right? Then you'll add it with what do you have again? The current account for Kagiso. The current account of Kagiso, it's 10,750. 10,750. So this will be the total equity for Kagiso. 650 plus the current account of 10,750 plus 10,750. Then I come across a total of 660,750. Right, guys. So now let's move on along to the total equity of Kagiso for 2020. Equity of Kagiso. I'm gonna take the capital contribution of Kagiso for 2020, which is 750,000. Then we'll add it with the current account of Kagiso. But look here, guys. It says the current account of Kagiso, it's on the debit side. So if the current account of Kagiso is on the debit side, meaning Kagiso at the end of June 2020, he owned the business. He owned the business. The amount of 15,550. So we will have to subtract that amount. Why? Because of it's not a positive amount that the Kagiso have in his current account, but it's the amount that Kagiso owe the business, right, guys? So it's 500, 15,500, right? Then we'll come across our equity of Kagiso is 734,500. Right, guys? Then for me to get my total equity or my average equity, I will have to add 650. Let me just make this. I'll have to add 650,750. I'll have to add it with 734,500. And I come across the amount of 1,295,250. Then to get my average equity, this is the total equity for 2019 and 2020. Then for me to get my average equity, I will have to take the very same amount, 1,395,000. I'll have to take my 1,395,250 and divide it by 2 so that I can get my average equity. Here we go. Then this amount of 697,625, that's my average equity. So I'm gonna post it here. It's 697,625. That's my average equity. So now let me just get my total total earnings. My total earnings is 47,250 plus 168,750 plus 16 1. Okay, then I come across the amount of 217,620 as my total earnings. Right, guys, then I will have to divide it with my average equity of 625. Right, guys, 625. Then this amount I have to multiply it by 100 over 1 to get my total earnings in the form of percentage, right, guys? So I will come across my percentage as how much. Let's calculate the percentage, guys. 620. Then I have to divide it with 6, 7, 6, 25. Then I have to multiply it with 100. There we go. Then 31, this 31 is going to be my my percentage, guys, right? So the total earnings of this particular partner is 31%. That's his total earnings, right, guys? Yes, so now we are going to move all along to 4.2.1. So let's move all along to 4.2.1. Right, guys? So 4.2.1. So guys, what's happening here, right? I know some of you guys have solution for this one, right? So when it comes to this type of question, guys, there are a lot of operational marks, and we are going to mark you guys according to the principle that you have applied. So don't mind the ratio. The ratio, they may not be the same as the solution. Why? Because of converting, right? You may find out we convert it in this way, then they convert it in that way when it comes to the solution. So don't mind your conversion because of they are always operational mark, right? You may find out in memorandum they didn't convert it in a proper way, or they converted in other way, the way they converted it. But you have converted in this way. So apply what you know. So if you practice this type of question, practice with your calculator, don't practice with the memorandum. What you have to know is know your formula. After knowing your formula, place all the necessary amount or all the amount. If we have as a test ratio, if this is your total of your current assets, then this is your total of inventory, just place it as it is. And don't fight to get the same answer that you get on a memorandum. No. Memorandum, they may convert it in another way. Just apply what you know. If you convert it in this way, it's still going to be correct. Convert in a way that you are taught. Right, guys? Convert it in a way that you are taught. There's no way you're going to get it wrong. If they give you wrong, then go for remark. Go for remark. Right, guys? So just place your amount as they are. Convert the way you are taught. Convert it the way you are taught. Don't force to get the same percentage as the way they got in memorandum. Right, guys? So now let's move along to 4.2.2, 4.2.1. 4.2.1. So 4.2.1 is it provided figures, financial indicators, or calculation in each case below to support your comment and explanation. So when you go to 4.2.1, they say comment on the liquidity of the business and explain in which year the working capital was managed more efficiently. First of all, ask yourself, what am I required into this question? They say comment on the liquidity. Comment on the liquidity. If they say comment on the liquidity, what you have to know is your liquidity ratios. So make sure that you know your liquidity ratio. Your liquidity ratio, they are basically your asset test ratio, your current asset ratio, and also your, I can say, your working capital, whereby you will take your current assets subtract by your current liability. So let's further continue with the question. The question it says, and explain which year working capital was managed more efficiently. Ask yourself, what is working capital? A working capital is actually the amount that it's actually the money that the business used to manage the business, the day-to-day operation of the business. That's the working capital. A working capital is the money that we use to manage the day-to-day work, the day-to-day operation of the business. That's the purpose or that's the meaning of working capital. And what is the formula of working capital? For us to get the working capital, we take our current assets, we subtract it with your current liabilities. Then you will get your working capital, the money that the entity used to manage the business, the daily operation of the business. So here we are required to comment on the liquidity. Please, when you comment on the liquidity, first of all, identify the ratios, the liquidity ratio. Like I said, its asset test ratio is current assets, and also you can use the working capital whereby you take your current assets subtract by your current liabilities in case whereby you are required to explain the working capital. I hope it does make sense, right, guys? So when you comment, guys, you check the difference between last year ratio and the current year ratio. That's the first step. That's the first step that you have to do over 6 months by checking the difference between the previous current ratio and the current one. I think you will score yourself a 2 marks. Just simple. You check the difference. Then you comment there was a decrease and decrease from last year to this year. There's a decrease or there's an increase. You score yourself marks, guys. 3 marks when it comes to comment. The first thing that you have to do is to check the difference between your previous and your current. Right, guys? So let's start first by identifying our current ratio, current assets. Ratio. So the current assets ratio, it's actually your current asset divided by your current liability. That's your current ratio. So guys, we will take your current asset divided by your current liability. Right, guys? Like I said, we have to go to the current assets ratio. Here's the formula. financial indicators from 2019 and 2020. Then we go to the current ratio. This is the current ratio. Current ratio. I said current asset. So it's current ratio, guys, right? When we go to our current ratio, we comment, okay, from 2019, from 2019 to 2020. On 2019, on 2019, we had 2,4 is to 1. Then 2020 we have 1,5 is to 1. Sorry, 1,5 is to 1. Right, guys. So when we check the difference between 2019 and 2020, we can all see from 2019 it have decreased from 2,4 to 1,5. Then you comment, simple, guys. You said there is a decrease. There is a decrease. There's a decrease of. You check the difference between 2,4 and 1,5. The difference between 2,4 and 1,5. You check the difference. It's actually 0,9. So there's a decrease of 0,9. There's a decrease of 0,9 is to 1. Just by doing this, guys, you score yourself, I think it's 2 marks. You comment, guys, there's a decrease, there's an increase, right? So I'm going to tell you guys how to comment on a decrease or what caused the decrease and increase. So let me just post all other ratio. Is it test ratio? Remember, I said to you guys, the liquidity ratio is current ratio, acid test ratio, and you can check your working capital if you are required to focus on the working capital like the question suggested. So let's check what is our working capital, not working capital, but the acid test ratio for 2020. Right here we go. We have calculated here, right? It's 1,05 is to 1. So it's 1,05 is to 1. 2019 2020 the ratio is, and then 2019 the ratio is 1,6. 1,6 is to 1. Right, guys? So now you comment. In this instance, when it comes to acid test ratio, there's a decrease, guys. As you guys can see, it's from 1,6 to 1,05. So you comment there is a decrease. So that you comment there's a decrease. What is a decrease? 1,6 subtract. So there's a decrease of 0,55 is to 1. Right, guys? So lastly, I would like us to calculate the working capital. Let me just place my figures. I will explain later, guys. Working capital for 2019. And the working capital for 2019, like I said, guys, you have to check the difference between your current assets and your current liability. So in this instance, my current assets, it was 550 for 2019, 530,250. Guys might say it was 530,250. Then I have to subtract it with my current liabilities of 219,000. And here we go. This is my working capital for 2019. Then let's move on along to the working capital. Working capital for 2020. For 2020, right? So here I have my current assets as 294,650. Then I have to subtract it with my current liability of 190,500. There we go. Then we are done with identifying the ratio of liquidity. 6 marks. I think over the 6 months you guys can score yourself 4 marks. Then I think the comment is just going to be 2 marks just by identifying these guys. Like you identify what is given. It's actually what is given here. We have calculated the acid test ratio. We just place it there. The current ratio, it's given. You just like post it here and check the difference. Then you score yourself a 4 marks. Even without identifying working capital, you can score yourself a 4 marks just by identifying acid test ratio and the current ratio. Working capital is just a bonus. I just want you guys to understand the working capital. How does the working capital work? Right, guys? So yeah, let's go to the question again. Let's go to the question again. It says, comment on the liquidity of the business and explain in which year the working capital was managed more efficiently. Okay, so I want to take you guys through to this table before I can comment. So guys, as you guys can see here, we have calculated our current ratio. Like I said, the purpose of current ratio is to check whether are you able to settle your current liability with the current assets that you have generated within the current financial year. Right, guys, that's the purpose of current ratio. So if there's a high current ratio, remember the current ratio formula, like I said, it's current assets divided by current liability. So we can all agree if there is a high current ratio like we have here in 2019, 2019 is 2,4. I just want you guys to know what caused the current ratio to be high. It's 2,4. So in 2019 it's 2,4. Remember, like I said, the current ratio formula is current assets divided by current liability. Right, guys? So under my current assets, remember, I have my inventory, I have my trade and other receivables, I have my cash and cash equivalent. So if my ratio is high like it is in 2019, 2,4, that simply means I sell more stock on credit to my my debtors. And that simply means again that I hold more stock. I hold more stock. I hope it does make sense, guys. Don't get it like too tricky. So if the ratio or the current ratio is high, it's either I sell more stock on credit or I keep more stock on hand. So meaning in that case, I'm not selling, like the business, it's not operating well. If you're going to keep a lot of stock at the end of the current financial year, meaning you didn't manage to sell all your stock or you didn't manage to sell most of your stock, that simply means you are holding a lot of stock at the end of the current financial year. It's either maybe you are selling a product that Like that is not necessary. Like it's not a necessity. Most of the people, they don't need that product. Or it's either you can advertise your product. If you're going to hold a lot of stock at the end of the current financial year, it's either you don't have a lot of target on that product. You don't have a lot of target on that product, or you don't advertise product, or it's either maybe the location where you are, you don't have a lot of customers who need that product. So I don't want to go deeper, but then I just want you guys to check how are we going to analyze this ratio. Like it's very nice. Here we discuss, guys, we talk about future things like current assets. Like if you get a ratio like this, current ratio, know the formula. After knowing the formula, know, okay, if the formula is current assets divided by current liabilities, what falls under the current assets and what caused the current assets to increase. Under the current assets, we have trade and other receivables. What caused the trade and other receivables increase? What caused the trade and other receivables increase? It is when we sell on credit. We don't sell a lot of stock on cash. And also what can cause the current assets to increase is the higher value of trading stock. What increased the higher value of trading stock? It's when we hold a lot of stock on hands. Like you interpret this formula, guys, you interpret this formula, but then don't overthink when it comes to the question. Like this question, it says focus on the working capital. It says focus on the working capital. So now I'm giving you more information, not only with regard to working capital, but I just want you guys to know what caused the trade and other receivables increase. High debtors when we sell on credit. When we sell on credit, our trade and other receivables increases. So our advice, it can be maybe for us for our for us to decrease this particular ratio 2,5 maybe to 1,5 or to a lower ratio than that one, then we have to minimize selling a lot of stock on credit. We have to sell a lot of our stocks on cash. Remember, when it comes to financial indicators, we interpret financial information so that we can make a valid decision, so that we can make valid decisions in the next current financial year, so that we cannot make the very same mistakes. Right, guys? So if you're going to sell a lot of our stock on credit, therefore there's no inflow of cash into the business. There's no cash flow into the business. There's no cash flow into the business, and we need cash flow into the business. There are some of the expenses or any other things that need cash into the business. So it's a must for us to have a cash into the business. But if we are going to sell a lot of our stocks on credit, we are not going to have the movement of cash flow, and that's going to be a problem into the business. Interpret your financial indicators, guys. And also what can cause this current ratio to increase, that's when by we hold a lot of stock. Hold of stock. If you're going to hold a lot of stock, that simply means we don't have a lot of customers for that specific product. Then why can't you just change the product? Can you guys see what's the purpose of financial indicators? You interpret it, okay? If I'm going to hold a lot of stock into the business, meaning the product it's not uh, 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 it's not bought. Like most of the customer, they don't buy this particular product. Why can't you just change the product so that we can see so that we can sell the product that the customer love, or to target a particular customer with different product? Or maybe the problem can be maybe the location where you are. Maybe the location where you are or where you place your business, maybe those people, they don't need that particular product. Then why can't you just relocate? Look where your customers are. You have to have your target customer, and you have to know where your customer are. So relocate and go and look out for a better location. Go and look out for a better location whereby you can sell those products to customers who need this product. Or maybe there's a lot of people who are selling that particular product in that location, and they are selling it with lower price than the way you are selling it. So why can't you just at least decrease your selling price? Maybe at least decrease your selling price, offer some discount to the customers so that they can be a movement, so that they can buy, guys. can you guys see how do we interpret the financial indicators? That's how we interpret the financial indicators. Then now let's go to acid test ratio. Remember the formula of acid test, like it's very important to know the formula of acid test, like to know the formula of all. Let me just not say only the acid test ratio, but the formula of all your financial indicators. If you know the formula of your financial indicators and you know the purpose, it will be very easy to apply that theory. I hope you're still on the same page. So when you go to acid test ratio, guys, where's my acid test ratio again? Okay, here it's my acid test ratio. Remember the formula of acid test ratio, that's where we take our current assets, we subtract by the inventory, then we divide it by our current liability. So meaning basically we are going to calculate our ratio based on our trade and other receivables and cash equivalent. So we want to see, are you able to settle your are you able to settle your are you able to settle your current liabilities without depending on your stock, but rather depending on your trade and other receivables and also on your cash and cash equivalent? That's the purpose of acid test ratio. So if we see here, or if we check here from 2019, there's a decrease of 0.55. It have decreased from 1.6 to 1.05. I hope you guys can see that. It have decreased from 1.6 to 0.5. So what caused the decrease here? What can cause the decrease? The thing that can cause the decrease here, that's whereby maybe now you have changed your mind. You have seen in 2019 that I had a high ratio of 1.6. There was a high ratio of 1.6. Then when it comes to 2020, I changed my decisions now. I've changed my decision. Okay, now I'm not going to sell more stock on credit, but rather on cash. Hence, the ratio have decreased from 1.6 to 0.5. That is why it's very important for the entity to have the financial indicator so that they can make a valid reasons, not valid reasons, but to make a proper decisions in the next current financial year. So if this business, if like there's a decrease in this ratio, it's a good thing to the entity, meaning they have managed to make decisions. They have managed to fix their decisions. They have managed to fix their problems from the previous year. And when it comes to the current financial year, now they are managing some of their current they are managing their debtors. Now they are managing their stock. They made now correct decisions about their stock and also about their debtors. So if there's a decrease in acid test ratio, if there is a decrease in acid test ratio and current ratio, that's a good thing into the business. That's a very, very, very good thing into the business. So meaning they have taken a good decision in the current financial year, maybe to decrease by selling on credit to the customer. Maybe they have decreased their prices so that they cannot hold a lot of stock at the end of the current financial year, or maybe they have relocated to another place whereby there's a lot of customers there, whereby they will be interested into their product. That's what can cause the decrease actually in your current ratio and also in your acid test ratio, guys. I hope you guys can manage this. So now let's move all along to the working capital. Remember, I said to you guys, when it comes to a working capital, these are actually the money that we use into day-to-day running operation of the business. So as you guys can see, during the current financial of 2019, the entity used 211,250 working capital, whereas in 2022 they use only 150 working capital. So meaning this entity during the current financial of 2020, they have managed to settle their working capital. They say, okay, maybe we made some unnecessary expenses during the current financial year, during 2019. So how about we decrease that so that we cannot use a lot of working capital in 2020? Can you guys see the purpose of financial indicators? They make you to make a valid or a proper decisions in the next current financial year so that you cannot continue losing money like that, or so that you cannot continue applying the very same problem all over. Remember, the business is it's a going concern thing, guys. A business is a continuous thing. We are concerned about the future of the business. Remember, we have going concern principle. So this going concern principle or these financial indicators, they are forced by the going concern principle. Going concern principle, it says we are concerned about the future of the business. So you have to prepare your financial statements and also prepare your financial indicators so that we can make a proper decisions in the next financial year, so that we cannot repeat the very same mistakes that we did last year, we repeat in the current financial year. No. Why? Because of we won't see the future of the business. Like the business, it cannot operate for a long time if we keep on making one mistake continuously. The business is going to collapse. The business is going to collapse. So the going concern principle, it says, let's prepare the financial statements and also let's make our financial indicators so that we can make a valid, so that we can make a proper decisions, so that we cannot repeat the very same mistakes that we did in the previous year, so that we cannot repeat them in this current financial year. That's the purpose of financial indicators. They're informed by going concern. We want the business to continue operating in the future. Hence, we have to make financial indicators and take a proper decisions based on financial indicators. So now let's answer the question. I didn't yet answer the question. I was just like giving you guys more information about the liquidity ratio and everything, so that you guys can be familiar with these financial indicators. Very important. Can you guys see how am I analyzing this current issue? It's like it's something that you have to discuss in your mind. Like I can say it's a common sense, but in a business way. So you have to have a business mind so that you guys can be able to interpret this, and you have to know the purpose. A very important thing when it comes to financial indicator. Know the purpose of indicator. Know the purpose of indicator. So now let's answer this question. It says comment on the liquidity of the business and explain in which year working capital was managed more efficiently. Comment or explain in which year the working capital was managed more efficiently. I'm not going to type this, but I'm going to say it loud. Then you will put it in your own words. Or let me just type it. But then don't force. The reason why I don't like to write down the financial indicators comment, it is because of most of the student, they want to force the answer to be the same as mine. No, yeah, guys, you place whatever you think, you place with your own language, you place with your own common sense, but then please, it should be related to the business, or it should be related to the topic. Don't go out of the topic. The reason why I don't like to write it down, because of you'll want to force the language, the language that I've placed here. No, place your own language, place it with your own understanding. It will not be the same as memorandum, but it should be something related to the memorandum. So don't force your answer as always to be the same as your memorandum. As long as you have wrote something that make commercial sense, then you'll be awarded marks, guys. So now it says explain which year working capital was managed more efficiently. Then here it's my working capital. My working capital during 2019, it was 311,250. Then 2019, it was 1,150. We can all see that there's a decrease from 2019 to 2020. We incurred, or we have used more working capital in 2019 than in 2020. At least we have managed to minimize our working capital. Remember, a working capital, it's more like an outflow of cash into the business. So we can all agree that it was managed more efficiently during the current financial of 2020. Why? Because of there's a decrease from 211,250 and 104,150. So now we can say maybe the business, at least it have managed to manage its working capital. They have managed to minimize where they have minimized, so that their working capital can be at least lesser than the way it was on 2019. So their working capital was managed more efficiently on 2020. Then we can say maybe the entity did not hold a lot of stock during the current financial of 2020. As you guys can see, there's a decrease from 2019 to 2020. So the working the okay, capital was managed efficiently during the current financial year of 2020. We can say the entity did not hold law of stock during 2020. I hope it does make sense, guys. I hope it really does make sense. So my comment, it was the working capital was managed more efficiently during the current financial of 2020, sorry. Then we can conclude that for us to have a decrease in working capital, meaning the entity did not hold a lot of stock during the current financial of 2020. They have managed to sell most of their stock done in 2019. Right, guys? I hope you guys will not face any difficulties with regard to such questions again. Right, guys? So let's move along to 4.2.2. So 4.2.2, it says the partner decided to increase the loan during the financial year. Comment on this decision with the reference of degree of financial risk. So if you guys hear anything with regard to the loan and financial risk, note that you have to use your debt equity ratio. Anything that is related to financial risk and increase or decrease of loan, use your debt equity ratio. So now let's check the difference of our debt equity ratio. Debt equity ratio. So ratio. So in 2019, my debt equity ratio is how much? My debt equity ratio is 0.2. Is 0.2, 0.2 is to 1. And then 2020 is how much did we calculate it, right? How much was it? 0.31, 0.21 is to 1. Okay, now we are going to comment. Now we are going to comment based on. Let me just correct this one. 2020 ratio is 0.31 is to 1. What is Excel doing now? 2020 ratio is 0.31 is to 1. Okay, here we go. Right, guys. So now let's interpret this ratio. I want you guys to the question. It says the partner decided to increase the loan during the financial year. Comment on this decision with the reference to the degree of financial risk. Once you see something with regard to the increase of loan and also with regard to the degree of financial risk, please focus on your debt equity ratio. You will see when you go to grade 12, guys, will be like financial risk ratio. I think we're going to add more financial indicator. So it will be debt equity, and also the ROTCE. But now let's focus only on what is on our level, debt equity ratio. For now, we only focus on debt equity ratio. Let me just try to minimize my screen. Okay, anyways. All right, yeah. So now the screen is a little bit clear. I'm sorry for this comment, guys. Unfortunately, you guys won't be able to see this comment, but like that, you guys, you can go back to the video if you want to hear more about the comment. It's all about your common sense, your own understanding, guys, right? So I hope you did manage to understand 4.2.1, my reason, right, guys? So now we are coming to the degree of financial risk. Remember, I said to you guys, first of all, what you need to know is the formula. Of the indicator. Right, guys? That's very important. Remember, we said the formula for debt equity ratio, it's non-current liability divided by your equities, right, guys? And I said to you guys, a positive gearing or a positive indicator for debt equity ratio, it should at least be 0.5, or it's supposed to be less than 1. That's why we can say this is a positive gearing, this is a low risk, meaning the company is not in any of financial risk if your ratio is below 0.5. As you guys can see, in 2019, our ratio is 0.2:1. This entity during the current financial of 2019, it was in a low financial risk, or it was in a positive gearing. What do we mean by that? We are saying the borrowed fund, they are actually less than what is invested into the business. So meaning the money that is invested into the business, it is actually higher than what is borrowed. That's a positive gearing. But if we have a negative gearing or high risk of financial risk, or if we are in a higher financial risk, that's whereby my ratio is going to be 1:1, or that's whereby it's going to be more than 1, maybe 2:1. Just know that we are in a higher financial risk or in a negative gearing, meaning now the borrowed fund, they are more than what is invested into the business, and which can lead to the company or the entity or the partnerships or property to be liquidated. You guys get that part? So here we are required to comment whether this increase of loan, remember, the increase of loan, it will actually increase our non-current liabilities. It will actually increase our non-current liabilities or our borrowed fund, right, guys? So you want to see, or we are expected to comment whether does this increase of loan lead us to a higher financial risk or a low financial risk? That's the question. We have to comment based on that. So as you guys can see here, we have 0.5 and 0.31. So both for 2019 and 2020, the company is in a low financial risk or it's in a positive gearing. The borrowed fund for 2019 and 2020, they are less than what is invested into the business. As you guys can see, let's go. Let me just like take you guys to the current to the non-current liabilities and the equity. As you guys can see, the non-current liabilities for 2020 is 450, and the owner's equity is 425,800. My owner's equity, they are more than non-current liabilities. So meaning this company is in a positive gearing. It's not in any financial risk. Why? Because of the owner's equity, they are actually higher than the borrowed fund or our loan. Same applies to 2019. Our borrowed fund is 250, then my equity is 1,285,900. So this company, it's not in any financial risk, but then it's in a low financial risk. So our comment it can be, even though there was an increase of loan, even though there was an increase of loan during the current financial of 2020, the company is still in a financial risk. It's not in a financial risk, it's in a low financial risk. Sorry for that. Even though there was an increase of loan, but there was an increase between 2019 and 2020. Let's write that decrease. There's a decrease. There's a decrease of 0, no, there's an increase, sorry. There's an increase here, so there's an increase from 2019 to 2020. There's an increase of 0.2 minus 0.31. There's an increase of 0.11 is to 1. And are you guys aware that even though we have an increase, still it doesn't put a company in a financial risk? Why? Because of it's still below 1. My equities, they are still higher than my liabilities or my non-current liabilities. So this company is not in any of financial risk. It's in a low financial risk. So the partner decisions, we can say it had the effect. It had the effect in 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 uh, in our financial, but then it is not in a financial risk. It's still in a low financial risk, even though the partner they decided to increase the loan. The company it is still in a low financial risk. So even if they can maybe again decide to increase their loan, maybe if they face some cash flow problems or maybe they need immediate cash, they can do so. Why? Because of the company is still in a low financial risk. So their decisions of increasing the loan, it did not impact the business negatively. Why? Because of the company is still in a low financial risk. It is still in a low financial risk. They are invested money or their invested fund, they are still higher than the borrowed fund. So this cannot place the entity in any financial difficulties or in any high financial risk. I hope it does make sense. So we can say the entity is not in financial risk, even though they decided to increase their loan. The partner, they are still going to get better returns. Okay, let me just elaborate more on the partners. They're still going to get more returns, right? Remember, the partners, when it comes to partnership, the partner's profit is distributed according to the agreement, right? And is distributed according to the profit. So if we pay our loans, remember a loan you can pay it annually or you can pay it per month and everything, or the interest of it you can pay it per month, then you'll have the annual repayment, right? So even if, remember, the higher you take, the higher your loan amount is, the higher the amount you're going to pay, right, guys? So meaning if we manage to to uh, uh, to get a positive net profit or a higher net profit, we still have to pay our loans. We still have to pay our loans, our annual payments that we have to make for the loan. That annual repayment of a loan, it will not affect the business negatively. Why? Because of it's not like it's a higher amount that the entity have to pay. It's not like it's a high amount that the entity have to pay. Why? Because of this entity, it's actually effective. It's actually effective. They're able to generate more profit. So them paying a certain portion of loan, it will not affect their profit so much badly. So hence I'm saying at the end of the current financial year, when we are going to distribute the profit after subtracting the loan amount that we have to pay, these customers or these partners, they are still going to get a better returns. They are still going to get a better returns. Why? Because of the loan amount that are going to pay. It's nothing to them. It's nothing to them because of they are effective. They generate more profit, and the low amount that they're going to pay, it's actually a low amount that they're going to pay. So at the end, they're still going to get a better returns. I hope it does make sense. So let's move all along to 4.2, 4.2.3. 4.2.3. So it says comment on Kagisho's return on the investment in the partnership. Provide one reason why he should be happy with his returns. Provide one reason that should be happy with returns. So guys, when it comes to the returns, please, a debt equity ratio is also applicable when it comes, not the debt equity ratio, but rather the interest on loan. It's also applicable in the investment if you are required to comment on the returns of a particular debt. Remember, we're not talking about the partners. We are talking about the people investing into the business. So these people, those people who invest into the business, they should have something in return, like the way we have calculated in 4.2.1. Remember, in 4.1.3, we calculated the returns earning of Kagisho. That's what is going to get in return for what he have invested into the business. So this investment of Kagisho in the business, we are going to compare it with the interest on loan. Maybe if it happened that Kagisho, he or she want to check whether am I going to benefit a lot if I invest into the business, or if I take my money and invest in some of the bank. Do you guys get my point? If maybe I loan this money to the bank, this is the interest that they're going to give me. If I take the very same amount of money I invest into the business, this is the returns that I'm going to get. Hence, I'm saying when it comes to the returns, you check the difference between the interest on loan and also the return earnings of the business. We have to compare whether it is a good business to it is a good decision to invest into the business, or rather to take your amount and invest it or loan it to the bank. So we have to check the difference between those percentages, or between those earnings. If the entity, if the returns they are high when a Kagish or this partner is going to invest into the business, then it's advisable for this particular debtor or this particular investor to keep on continuing on investing on the business. But if the return percentage is if the return percentage on the business is lower than the interest on loan, then it's advisable for that particular debtor to invest into loan, or to loan his money to the bank, so that he can get more returns than investing into the business. I hope it does make sense. So now let's check the return earned by Kagisho according to 4.1.3. According to 4.1.3, the returns earned by Kagisho, it's 31%. It's 31%. That's the return earned by Kagisho into the business. If he invests into the business, he's going to get the return of that 1% on what he have invested into the business. Yes. And when we go to the loan, let's check the interest on loan. How much is the interest on loan? Here we go. And interest on loan, or interest rate on alternative investment, it's 8%. So if you are going to invest into alternative investment, then you are going to get the percentage of 80%. Just imagine, into the business, you're getting the percentage of that 1% based on what you have invested. And on top of that 1%, there are some of the bonuses that you're going to get. there are some of the salaries that you're going to get on top of this 31%. Can you guys see? It is a good idea to invest actually into the business. Why? Into the business, we have a lot of benefits. We have bonuses, we have salaries, we have also some of benefits that you'll get on top of the interest that you're going to get. Then when it comes to the investment, or when you, if it's alternative investment, maybe it's another investment, but you don't, it's not investment that is related to the business. Maybe it's an investment on loan. Maybe you decide to buy shares. Maybe you decide to loan your money to the bank. That's alternative investment. So in alternative investment, you're going to get the percentage of 8% for what you have invested in those investments. Can you guys see? It's a way, it's beneficial to invest into the business rather than investing in alternative investment. Why? Because of, in a business, there are better returns than in alternative investment. And on top of those better returns, you are still going to get salary, you're still going to get bonus on top of your 31%. Can you guys see? Can you guys see that? So as always, when you are required to check, to comment on the returns, check the returns in percentage of the business and also of alternative investment, or also or of interest on loan, and comment between the two. Check which one is higher and advise that particular partner on where to invest. So provide one reason why he should be happy with his returns. I can say you should be happy with your returns. Why? Why should you be happy? Because of, at least you're going to get that 1% into the business rather than going to some of alternative investors whereby you're going to get the percentage of 80% of 8%. So you should be happy. You should be happy because you're going to get more returns than in other investment. Can you guys see that? Can you guys see that? Can you guys see that? So let me just place my comment. The partner should be happy because he is getting more or higher returns than in alternative investment. Then you score yourself, guys. How many marks for this one? You score yourself 3 marks, guys, just by applying this, guys. And trust me, guys, these questions, they are repetitive. They are repetitive. They repeat themselves. This question, they will stay like this in each and every question paper from grade 10 to grade 12. They never changed. They stay like this, guys. So do yourself a favor, master these questions so that you guys can score yourself a 30 marks. Like, this is a free 30 marks, guys. This is a free 30 marks. So let's go to another one. It says provide one reason why he should be concerned about his returns on his investment and give an explanation. This one, I can say this was the only challenging question in 4.2.3. It says provide one reason why he should be concerned about his return on his investment and give an explanation. Guys, remember I said to you guys, your returns are actually based on what you have invested into the business. So the more I'm going to invest more, is the more I have to get more, guys. Is the more I have to get more. The more I invest into the business, the more I have to get more. So let's check what this particular debtor have contributed to the business. So when you go to a capital contribution is actually what you have invested into the business. Right. So when we check this particular debtor, from 2019, this particular debtor invested 615 to this business. Then at the end of 2020, there's an increase. We have found out on top of 650. This particular debtor invested more so that his capital contribution, it can be 750,000. So if we check the difference, we can say there was additional capital from 2019 to 2020. So you guys can see the capital contribution, it's 650 2019. Then at the end of 2020, it's 750. So meaning within the current financial of 2020, this particular debtor invested more. There was some additional for this amount to become 750. So let's check how much additional contribution he made in this particular business so that for it to come across 750,000. I've come across the amount of 100,000. 100,000. So meaning this particular debtor during the current financial of 2020, he invested, let me just write it as additional contribution. So this is my additional contribution. So this particular debtor invested 100,000 during the current financial of 2020 on top of 650. So if you invest more, meaning I'm expecting to get more returns, then when you go to the next partner, a Radaba or a two. So this particular debtor, during the current financial of 2019, he invested 700,000. But at the end of the current financial year of 2020, we found out there's a decrease from 700,000 to 765,000. So meaning this particular debtor withdraw from the capital contribution of 700,000. So meaning he or she have withdrawn some of amount of money from 700,000 for this amount to become 675,000. So let's check how much he or she withdraw. So I found out this particular debtor, he or she have withdrawn the total amount of 25,000. So this was withdrawal. So this was a withdrawal for Radaba. Then this was the capital contribution for Kagisho. So Kagisho invested 100,000. Then Khadebe withdraw 25,000. Then let's check whether how was the year returns distributed. Let's go to the returns for 2020. We found out when we calculated the returns for Kagisho during the current financial of 2020. This debtor earned 31% as his returns. And on top of that, during that current financial of 2020, he invested how much? He invested 100,000. He invested 100,000 and he gained the returns of 1%. Then this particular debtor, he withdrew 25,000 from his capital contribution, but look at his or her return is 38,000. Will you be happy? Like you invest more and some of person withdraw from his capital account, but he or she is getting more returns than you or than yours. That's totally unfair. I can invest 100,000 from what I have invested. Then this particular debtor, this particular partner, he withdraw from his capital contribution of 20. He withdraw 25,000 from his capital contribution, but he or she get more return than I, whereas I have invested and this particular debtor withdraw. So can you guys see how unfair this is? Will you be happy with that? No, obviously will not be happy because of I sacrifice, I take more so that I take more in expectation of getting more. But this person withdraw but is getting more. That doesn't even make a commercial sense. It doesn't make a commercial sense. So I won't be happy. I won't be happy. I won't be happy at all. I won't be happy at all. But at the end, remember, we are in a partnership here. So I'm just like gonna go a little bit out of the question. The answer for this question is that this particular debtor, he or she, Kagisho, he or she will not be happy. Why? Because of he invested 100,000 during the current financial of 2020, whereas Radebe withdraw 25,000 during the current financial of 2020, but is getting more returns of 38% than Kagisho. Kagisho is earning 31%. So it's not fair. So it's okay for Kagisho to not be happy. Why? Because of he invested more, whereas this one withdraw, but the one who withdraw, he or she get more returns than Kagisho who invested into the business. That's the answer. But again, what will cause the returns to be higher, even though you have contributed more? Remember, at the end, we are in a partnership here. A partnership, it's an agreement. If you have an agreement that you are going to get this and I'm going to get this, that's an agreement. Then it have to be so. That's an agreement. But like then, let's just like not go out of the topic. But like then, just try to make commercial sense out of it. Try like to think out of the box. Try to think of the box when it comes to financial indicators. So now we're about to wrap up, guys. So let me just type the answer. Karisho, let me just say KG will not be happy about his retains as he contributed 100,000 but get that 1% returns, less than Radaba returns, whereas Radaba withdraw whereas Radaba withdraw 25,000 and get higher returns of 38,000 than Kagisho. I hope it does make sense, guys. I hope the session it was beneficial. I don't mind my language, guys. Just listen to the principle, what is important. Bye, guys. So welcome to the end of the session. This is how you collect your 30 marks. So if you guys still face more difficulties about financial indicators, you guys are more than welcome to text me. WhatsApp me on 083 427 3112. I will give you guys some few notes with related to financial indicators. I think they will be helpful. They will be very helpful. So guys, this is the end of our session. Let's meet again on the next session. You guys will tell me what to present in the next session because of at this stage I need to be guided by you guys. So at this stage I have to be guided by you guys. Right? So please tell me what to present in my next session. So comment on the comment below. Drop each and every topic that you would like us to present in our next video. Drop the topic that you guys would like us to present in our next video. I hope this one was beneficial, and I hope you guys will never face any difficulties with regard to financial indicators. So please, guys, let's interpret the question for the last time. Guys, fixed assets. If you guys would like us to present the whole question paper, you guys are more than welcome to comment on the comment box. We will definitely present the whole question paper. according to instructions. But we'll present a question 1 to question 3, as we have already presented question 4. Fixed assets, guys, please make sure that you collect that 30 marks. It's for free, guys. It's for free if you know your principle. So, guys, I've compiled more basic fixed assets note that I think they will be very helpful. So, if you guys want some few notes with regard to the fixed assets, you guys are more than welcome to text me or email us on edu101gurus@gmail.com. You guys can send us an email. We'll communicate via email or via WhatsApp 083 427 2112. Guys, please don't forget to like, share, and subscribe. You can also follow us on Facebook at EDU-GURUS young Twitters. You can follow us there. Follow our page. Drop, guys. You guys are not following up with my videos, guys. Please like, share, subscribe, guys. Comment box, it's very empty. I check my comment box each and every day, but you guys are not commenting and you guys are not watching the whole videos. You guys are not watching the whole videos. Like the videos that I've issued, trust me, they're very beneficial. So I think in our next session, I will be presenting creditors reconciliation, because of most of the students are struggling with creditors reconciliation. So I'm going to give you guys some of the important basics about creditors reconciliation. But please make sure that you know your format when you go write your paper. What if you didn't practice enough? But please make sure that you know your fixed assets format is always most of the time fixed assets is given in your answer sheet. But when it comes to income statement, balance sheet, guys, please make sure that you know your format, especially balance sheet. Know your format so that you guys can collect free marks. There are a lot of operational marks when it comes to balance sheet. Please don't miss this lot of operational marks. Balance sheet, there's a possibility that you may get distinction in balance sheet with incorrect amount. But the format, if the format it's proper, then you'll be entitled for those principal marks. Then income statement, know what falls under your other incomes, know what falls under your operating expense, or otherwise we are going to penalize you. If you are going to post incomes in operating expense, you're going to be penalized. So make sure that when you go write your test, you know your format. Please, please, please know your format, know your rent income adjustment. Those are the adjustment that contribute a lot of marks. Know your salaries and wages account. If there's an omitted salaries and wages, know how to treat that. Know your advertising, guys. Advertising, it also contributes a lot of marks. It can appear in a form of increased decrease. Like, guys, please practice. Distinction is very possible in grade level. 96% is very possible in grade level. So this is me signing out, guys. This is still your boy EK video from EDU-GURUS. You know, when in garage, you don't have the best, but then guys, you got it wrong. I love you all. Dango.